Today, our mission is pretty simple. We want to give you the ultimate shortcut to understanding the health of the U.S. economy, straight from the source. We're diving deep into the latest Federal Reserve Beige Book. This is the intelligence they gather from the ground up right through the first week of January.
And this is really the document the Fed uses to make its biggest decisions. It's their eyes and ears.
So if you're looking for the headline, what's the big takeaway?
Well, you get it right away. The report says that since about mid-November, economic activity across most of the U.S. has shown a recovery pace they describe as slight to moderate.
Slight to moderate. Okay, that sounds a little underwhelming, doesn't it? I mean, after the volatility of the last few years, is that really good news or is it just economic noise?
No, it's definitely significant.
Yeah.
It really is. Especially when you zoom out a bit.
Okay.
You have to remember where we've been. For the last three reports, the phrase was basically economic activity showed little change. Just stuck.
Right, we were just treading water.
Exactly. So moving the needle, even to slight, signals that the whole trajectory is shifting. And what's really compelling is that they measured this after the end of that historically long government shutdown.
So the economy found some momentum despite that friction.
It did, which sets the stage perfectly.
So where is this momentum actually coming from? Is this just a few hotspot cities, or are we talking about broad-based strength across all 12 Fed districts?
It was surprisingly broad. Most districts reported things picking up, lightly to moderately. But the real juice is in the regional stories.
The anecdotes.
The anecdotes.
Yeah.
Take manufacturing, for instance. It's always seen as that canary in the coal mine.
And we saw a great example in the Cleveland District Report. Manufacturing demand there saw a moderate rebound. And that's a real change, right? I mean, that sector had seen round after round of just flatness or even decline.
A huge change. And the driver for that rebound tells you so much about where investment is flowing right now. Some of the producers in Cleveland specifically pointed to data center construction.
Data center. So we're not talking about people buying more widgets.
No. This is capital being deployed for the whole AI and digital infrastructure build-out.
That's a crucial connection. It implies the demand isn't just fleeting, it's tied to these long-term tech shifts. I mean, data centers are built for years of use.
It absolutely is. Consumer demand can spike and fade, with holidays or trends. But data center construction, that signals committed corporate investment. Confidence.
It's structural growth?
It's structural growth, exactly what the Fed wants to see.
Okay, but it can't all be good news. Not every part of the economy is riding the digital boom. The sources flagged some real softness in logistics and transportation.
Yeah, particularly around the Chicago district.
What's happening there?
That's the cautionary note. While manufacturing is picking up, actually moving the goods is still sluggish. In Chicago, trucking demand was flat and freight rates were weak.
So a margin squeeze.
A huge margin squeeze. One freight consultant was even quoted projecting that some of the smaller trucking fleets might just exit the market this year.
Wow. That really sounds like a tale of two economies then. You have corporate investment booming for tech, while the infrastructure to support it, the trucks, is actually shrinking under pressure.
It highlights the unevenness of this slight to moderate growth. It really does.
Okay, so if that's the activity pulse, let's talk about the engine. The labor market. This is always what the Fed scrutinizes most. What did the Beige Book contacts say about jobs?
What jumps out immediately is just the lack of big, dramatic movement.
Stability.
Right. 8 out of the 12 Fed districts reported employment levels were, and I'm quoting, basically unchanged. The market isn't collapsing, but it's not on a tear either. It's settling.
And I assume wage growth followed that same trend.
It did. It was reported as moderate, and contacts all over noted that the speed of wage growth seems to have returned to what they call normal levels.
So that hyperacceleration we saw during the pandemic recovery is over.
It seems to have found a more sustainable equilibrium. But you have to dig into the anecdotes because they tell a slightly different story.
How so?
Take Kansas City. They had this fascinating report. A rural manufacturing plant had layoffs, but the personnel who were let go, most of them were reemployed within a single month.
Within a month. So is the labor market really cooling if workers are getting snapped up that quickly?
That's the skeptical question you have to ask. It suggests there's this deep resilience and an underlying demand for skills. The job might change, but the worker doesn't stay on the sidelines for long.
And what was their forward outlook?
Also optimistic, Kansas City companies actually said they expect hiring to increase in the first half of the year, especially in manufacturing.
We also got a very specific timeline out of the Boston district, right? It seemed to speak to that same kind of cautious confidence.
Yes, that was a perfect little nugget. They reported a rise in hiring temporary employees.
Right.
With the expectation that many of those roles will convert to permanent positions in early 2026.
So a year from now.
Exactly. It's a try before you buy on a massive scale. It's optimism about the future workload, but real caution about committing capital right now.
And while we're on managing capacity, the Atlanta district had a really interesting point about technology.
This brings the whole productivity discussion to the forefront.
AI.
Atlanta contacts reported they are accelerating their adoption of artificial intelligence, specifically to boost productivity and manage the size of their workforce.
But their sources said the immediate impact isn't going to be, a wave of layoffs.
Correct. They were very clear about this. They noted it will take several years for this to have a truly significant impact on staffing levels.
So it's an evolution, not a revolution.
It's an efficiency play before it's a cost-cutting play. That tempers some of the wilder headlines about AI, wiping out jobs overnight. It's a much slower process.
Okay, let's switch gears to the most complicated part of this whole report, the price puzzle. Inflation is still rising at a moderate speed.
Right.
But the sources highlight this one specific force that seems to be a real thorn in the Fed's side.
The lagged effect of tariffs. This is, I think, the centerpiece of the inflation story in this Beige Book.
Explain that mechanism. Why is it hitting now?
What's fascinating, businesses that initially absorbed the tariff costs, they ate the duties to keep their prices competitive.
To maintain market share.
Exactly. They are now being forced to pass those costs on to us, the consumers. It's happening because their old pre-tariff inventory is finally gone. The cushion is gone.
And this isn't just a theory. The sources gave us some hard numbers.
They did. In the Richmond district, tariffs are still hammering profit margins. They mentioned a small punching equipment company spending nearly $200,000 on import duties alone.
$200,000. For a small business, that is catastrophic, a cost you absolutely have to pass on.
And you see that cost trickling right down. In New York, a Long Island auto parts dealer confirmed that most of the cost increases from tariffs on goods from, say, India have been passed on to the buyer.
Which affects everything, repair costs, insurance premiums, you name it.
And the consumer gets stuck, even when policy changes for the better. There's that coffee roaster example.
Right, in New York. They said even though some coffee tariffs were canceled, their prices won't drop until they sell through their existing high-cost inventory.
Which could take months. It's a built-in drag that delays any relief. And if you connect that thread to the broader affordability picture, you see why households are struggling.
The Philadelphia contacts really hit on this. They said consumers are still struggling across the board: housing, cars, utilities, insurance, medical bills.
It's not just about the cost of a new TV anymore. It's the cost of just living.
Exactly. And San Francisco reinforced that. Retailers, construction firms, everyone reported raising prices to deal with rising costs from tariffs, utilities, insurance. It's systemic.
It's a systemic increase in the cost of doing business, which just gets pushed onto the customer.
So if the economy is growing slightly to moderately and jobs are stable, but these tariff-driven costs are keeping inflation sticky, that creates a real policy problem for the Fed.
A huge one.
Which brings us to the big question. What does this all mean for interest rates?
I think the report really solidifies the recent Fed consensus. The labor market, while resilient, has cooled down. So that part of their job, it's working. The rate hikes slowed demand without crashing the job market.
But that inflation picture with the tariffs, that's what complicates any decision to start cutting rates.
Dramatically.
Yeah.
Some Fed officials are deeply cautious about cutting rates precisely because inflation is still hovering above their 2% target.
And they can't really control the tariffs.
That's the thing. They know that as long as those policies are in place, they face this upward price pressure that's totally outside the scope of monetary policy. They can kill demand, but they can't eliminate a duty at the border.
So they're fighting a supply-side problem with a demand-side tool. It's messy. We know they cut rates 3 times in late 2025. What is the market pricing in now?
The market is reflecting that same caution. Investors are predicting the Fed's next rate cut won't happen until June.
June? Why so long? If growth is moderate and the labor market is stable, aren't they risking a slowdown by waiting that long?
It's a cost of error calculation. For the Fed, cutting too early and watching inflation reaccelerate would be a much, much worse outcome than waiting a few extra months.
So June gives them more data points.
A significant number of data points, especially on core inflation, to confirm that this tariff pass-through has stabilized. Their goal is durability, not speed. And their next meeting is January 27th and 28th, so we'll get a sense of the tone very soon.
Okay, so let's pull all these threads together. We've just done our deep dive. The takeaway seems pretty clear. A kind of Goldilocks scenario with slight to moderate growth and stable jobs, but with this persistent, moderate inflation problem being driven by the lag effects of tariffs.
Yeah, the economy is resilient, it's chugging along, but it's fighting this low-grade structural fever. It's stable, but it's not easy.
Here's where the perspective shifts, though, and this is fascinating. We've been talking about the ground-level data from the Beige Book, Main Street, but if you look at external surveys of institutional clients, the big money, Wall Street, their top risk for the coming year wasn't inflation. It wasn't a recession. It was a technology bubble collapse.
That is a crucial disconnect, a fascinating one. The Beige Book reflects the reality of Main Street, the cost of cars and utilities.
Right.
Meanwhile, the institutional world is obsessed with this massive systemic risk related to the valuation of the tech sector, which has driven pretty much all the market gains.
So the people on the ground are worried about their insurance premiums, and the big players are worried about a 2000-style wipeout.
Exactly. The local Fed contacts are seeing stability and moderate progress. The market is hedging against a catastrophic financial event. The two concerns barely even overlap.
So, what does this all mean for you? If the economy continues this slight to moderate improvement, this Goldilocks path, how will the Fed reconcile that steady progress with these growing fears among big market players about a tech bubble? If the economy stays stable, but the tech sector hits a wall, which narrative will the Fed prioritize? What will you be watching for next? That's your deep dive homework.
Something to keep in mind as we watch those numbers over the next few months.
Thanks for diving deep with us. We'll see you next time.